to Curious Commerce. Welcome to video 27 of our 50 videos capital budgeting series. Today, we are reaching a very important stage in our capital budgeting journey. Until now, we have learned how to calculate net present value or NPV. But after calculating NPV, one very important question remains: what do we actually do with the result? This is where calculation becomes decision making. Many students can remember the NPV formula, calculate the present value of cash flows, then subtract the initial investment and arrive at an answer. But sometimes they stop there. In finance, however, the calculation is only the beginning. The real question is, what does that number mean for the business? Imagine that a company is considering two investment projects, Project A and Project B. Project A has a positive NPV and Project B has a negative NPV. What should management do? Should the company accept both? Should it reject the both? Or should it select one? The answer comes from understanding the meaning of NPV. NPV is not simply a mathematical calculation. NPV is a capital investment decision making tool. Manufacturing companies, technology companies, banks, infrastructure businesses, and many other organizations use capital budgeting techniques to evaluate major investments. Suppose a company plans to invest 1 crore rupees in a new project. Management does not simply look at rupees 1 crore investment and approve it. They estimate future cash flows, discount those cash flows to their present value, calculate NPV, and then interpret the result. So, in today's video, we will understand what positive NPV means, what zero NPV means, and what negative NPV means, how to choose between the projects, how managers interpret the NPV in practice, and the common mistakes students make while interpreting NPV. By the end of this video, you should be able to confidently say positive NPV is accepted, zero NPV is indifferent, subject to strategic considerations, and the negative NPV means the reject the project. And when comparing mutual exclusive projects, choose the project with the highest positive NPV. So let's begin by quickly recalling the basic meaning of NPV. Before we discuss the decision rules, let us quickly recall what NPV means. NPV stands for net present value. The basic formula is NPV equals the present value of future cash inflow minus the initial investment. The important point today is not the calculation, it is the interpretation of results. Let us take a simple example. Suppose the present value of a project's future cash inflow is rupees 5 lakh. The initial investment is 4 lakh. Therefore, the NPV equals 5 lakh minus 4 lakh, that is the 1 lakh. So the NPV is positive by 1 lakh rupees. What does that 1 lakh tells us? It tells us that after considering the time value of money and the required return, the project creates the additional economic value of rupees 1 lakh. Now consider another situation. Suppose the present value of cash inflow is exactly 4 lakh and the investment is also 4 lakh. Then the NPV is 0. And suppose the present value of cash inflow is only 3 lakh while the investment is 4 lakh, then the NPV is negative 1 lakh. So we have three basic situations. NPV is greater than 0. The second situation is NPV is equal to 0. And the last situation is NPV is less than 0. These three results lead us to three different decision interpretation. There is also one fundamental principle behind NPV. The objective of financial management is wealth maximization. A project with a positive NPV creates value. A project with negative NPV destroys the value. So, NPV essentially answers a very important business question after considering the time value of money and the required return. Does this investment creates value? Now let us examine the first and most favorable situations. NPV is greater than 0. Friends, this is the most favorable situation for a company when the NPV is greater than 0. The project is considered to be value creating. What does positive NPV means? It means that the present value of a expected future cash inflow is greater than the initial investment after considering the required return. Let us take a simple example. Suppose a company invests 10 lakh rupees in a project. After discounting the expected future cash flow, the present value comes to 12 lakh rupees. Therefore, NPV equals 12 lakh minus 10 lakh. The net NPV is 2 lakh rupees. The project creates 2 lakh of additional economic value. So, what should management normally do? Generally, accept the project. In financial management, the term positive NPV, it increases the shareholder's wealth, assuming the underlying estimates and required return are appropriate. This is one of the most important principles in capital budgeting. Managers generally prefer projects that create value because the value creation supports long term business growth and shareholders' interest. Since the NPV is positive, the project should be accepted. Do not simply write the project is profitable. The better financial conclusion is since NPV is positive, the project should be accepted. The one more important point is a positive NPV means the project is expected to generate value above the required rate of return used in this analysis. That's why positive NPV is generally desirable. Now let us move to the second situation. NPV is equals to 0. A 0 NPV means that the present value of a expected future cash flow is exactly equals to the initial investment after considering the required return. For example, suppose the initial investment is 5 lakh. After discounting the expected future cash flow, their present value is also 5 lakh. The NPV is 0. This is an important point. 0 NPV does not mean that the project generates no return at all. It means that the project is expected to earn exactly the required rate of return used in the analysis. Therefore, there is no additional economic value created above that required return. In the basic NPV decision rule, the company is generally indifferent between the accepting and rejecting such a project. However, real business decisions can be more complicated. A company might still consider a zero NPV project because of strategic factors. For example, the project may help the company enter a new market. It may strengthen its competitive positions, or it may support long term strategy. It may improve the distribution or customer access. So, the practical management decision may consider factors beyond NPV. But for an examination purpose, remember the basic rule: NPV is greater than zero, accept the project. NP is equal to zero, it is indifferent. And remember the one more sentence: zero NPV means the project earns the required return. It does not automatically mean a financial loss. Now, let us examine the loss situation, that is, NPV is lesser than zero. The project is considered to be value destroying under the assumptions used in the analysis. Let us take an example. Suppose a company invests 10 lakh rupees. Its expected future cash flow is 8 lakh. Therefore, 8 lakh minus 10 lakh, that is negative 2 lakh rupees, that is NPV. What does this mean? It means that the project expected value is 2 lakh rupees below the initial requirement on the NPV basis. The project is not expected to earn the required return. Therefore, under the standard NPV decision rule, they reject the project. Now, an important question arises: why is positive NPV so important? Let us understand that next. Friends, now we understand the three NPV outcomes. But why do financial managers give so much importance to positive NPV? The answer is value creation. One of the central objectives of financial management is shareholders' wealth maximization. A positive NPV indicates that based on the estimated cash flows and required return, the project creates additional economic value. Let us understand this with a simple example. Suppose the required return is 10%. After considering the project expected cash flow and discounting at the required return, the project produces the positive NPV. That means the project shareholders value beyond the required return. This is different from simply saying that the company earns an accounting profit. NPV focuses on cash flow, the time value of money, and the required return. That's why NPV is considered a strong capital budgeting technique. It helps management to answer, will this investment create economic value or not? The logic behind the interpretations. If the two projects, Project A and Project B, has an NPV of 5 lakh rupees and 8 lakh rupees respectively, which project should the company prefer? If the projects are mutually exclusive, meaning the company can select only one of them, the basic NPV rule is choose the project with the highest positive NPV. or choose the project with the higher positive NPV. Because the higher NPV indicates greater expected value creation in absolute terms. The project with the biggest NPV is always the best in every possible situations. Projects with comparable assumptions or the projects with the mutually exclusive projects, the project with the higher NPV is preferred. This is the common examination question. The question may be, how do you select between mutually exclusive projects? The strong answer is select the project with highest positive NPV. Friends, let us make a comparison extremely simple. Suppose a company is evaluating two mutually exclusive projects, Project A and Project B. The NPV of Project A is 100 rupees, Project B is 200. Which project should we select? The answer is B because the project B's NPV is 200. It is more than the project A's NPV. Managers do not look at NPV as just a textbook formula. They use it as part of broader investment decision process. When management evaluates a major project, they normally consider several things. First, they estimate future cash flows. Secondly, they consider the timing of those cash flows. Thirdly, they select an appropriate discount rate or required return. Fourth one is they calculate the NPV. Finally, they interpret the result along with the risk and strategic consideration. This is important because the NPV is based on forecasts. The common mistakes in NPV interpretation. Sometimes people become emotionally attached to a project. They may like the idea of the project, the location, the technology, or the prestige associated with it. But if the financial analysis shows a negative NPV, management must carefully examine why. A project should not be continued simply because someone likes the project. Mistake number second is not comparing alternatives. Always we should compare the project with the another project and the higher NPV project should be selected. The wrong interpretation leads to the wrong selection of the project. Let's quickly revise today's entire lesson. First, NPV is greater than zero. The project should normally be accepted. If NPV is equal to zero, the basic decision rule is to remain indifferent. If NPV is less than zero, the project should normally be rejected. The fourth is when comparing mutually exclusive project, the higher NPV project should be selected. Please revise today's entire lesson. If NPV is greater than zero, accept the project. If the NPV is equals to zero, it is the project is indifferent. If the project NPV is lesser than zero, let us reject. And in the case of a mutually exclusive project, higher NPV project should be selected. Uh, with this, we have completed another important step in our 50 videos capital budgeting series. In the next video, we are discussed about the advantages and limitations of NPV. Stay curious, stay with Curious Commerce to know the real business secrets and real financial markets. If you need daily updates, follow WhatsApp channel Curious Commerce Financial Management Hub. Please like, share, and subscribe. Thank you.